Good evening, students. I hope you are fine. Today, we shall start a new topic, which is the statement of cash flows. This is an important topic, not only in accounting, but also in finance. My name is Kirtiman Sharma. I am a chartered management accountant. Please give me a moment. Let me share the PowerPoint slides with you, and then I shall explain you everything in a simple, lucid, and detailed way. The learning objectives of the statement of cash flows topic are: understand the purpose of statement of cash flows, distinguish between operating, investing, and financing activities, prepare a statement of cash flows, and analyze the cash flows from operating activities using the indirect method. All right, guys. So what is the purpose of a statement of cash flows? That is the first question that should come into your mind. You see, guys, in a very simple way, cash flows is about inflow and outflow of cash in an organization, but only cash, right? Cash flows is different from the profit or the income. Profit can be generated even without cash flows taking place, or some cash flows taking place, and sometimes cash flows not taking place. But cash flows is only when the cash flows, either it is coming into the business or it is going out of business. So a statement of cash flows will reflect how does a company obtain its cash? From where is it obtaining the cash? Does it obtain cash by selling the goods and services? Or is there any other way or ways in which the company has obtained the cash during the fiscal year? Where does the company spend its cash? Does it spend its cash by purchasing the raw materials in case of a manufacturing company? Does it spend the money by paying the salaries to the employees? Or what are the different ways in which it is spending its cash? And ultimately, this will help us to understand what explains the change in the cash balance from the beginning of the year to the end of the accounting year, or from the end of the previous accounting year to the beginning, to the end of this accounting year. I would like to give you one example how important the cash flows are before I move ahead with more on this topic. In United States, there was a company by the name W.T. Grant Corporation. It was a merchandising company. It was a very huge merchandiser of different goods. It's a classical example of how cash flow information is important in predicting the company's future performance and its financial strength. Grant reported, this company by the name Grant, in short, you can say, it reported the net profit of more than $40 million per year for 3 consecutive years. But at the same time, it was experiencing an alarming decrease in its cash from operations. For instance, net cash outflow was more than $90 million by the end of that 3-year period. So this company soon went bankrupt, unfortunately. Users who relied solely on Grant's profit numbers were unpleasantly surprised. This reminds us that cash flows, as well as the income statement and the statement of financial position, or the balance sheet as we say, they are very important in making sound business decisions. Okay, so it's not only about profits, it's not about the financial health only. I mean, those are important, but so is the uh, knowledge about the cash flows to the users like investors, creditors, and the managers themselves. So nowadays, before investing, even if one is a small investor or an institutional investor, they should also look at the statement of cash flows of an organization. Significance of cash flows. What is its significance? So as I told already, it is very significant for the users or the stakeholders like investors, creditors, and the management of the company itself in assessing the way in which the firm has financed its operations. How is it is it through borrowing of money, or is it by issuing of debentures of the company, right? So the creditors, investors are also able to assess whether the company is able to meet its short-term and long-term obligations, and is it in a position to pay the dividends or not. Both the cash and the non-cash aspects of the company's investments and its financial transactions for the period can be known to the users of finance of the company through the statement of cash flow. What causes the change in cash between the beginning and the end of the accounting year? So here it's about cash and cash equivalents also. So guys, whenever we discuss about the cash flows, we are talking about cash and cash equivalents also. Cash equivalents could be, for example, your cash in the bank, the company's cash in the bank, which can be converted into cash very easily, or it is already in the form of cash. Whether the company will be able to generate future positive cash flows or not, that also can be reflected by an understanding of the cash flows. Now, the important thing is when we talk of cash flows, when we discuss about cash flows, we are discussing about three activities: operating activity, investing activity, and financing activity. So these are the three activities that determine whether the company will have a positive cash flow or a negative cash flow during an accounting period or a fiscal year. Operating activities are those activities which basically help the company to generate the revenues. Those day-to-day activities like selling of the goods, or if the company is in a service business, the selling of their services, I mean, providing services to the customers, that is an example of an operating activity. Cash payments also are part of operating activities, like cash payments made to suppliers from where the company purchases the goods or the services. So any principal revenue generating activity of an organization, right, that will be an operating activity. Investing activities are those which relate to acquisition or disposal of the long-term assets like machinery, like plant. And if a company makes any investment, for example, investment into the equity of another concern, another company, that would also be categorized as investing activity. Investing activities normally have a long-term horizon. So as I told you already, if a company purchases or sells plant and equipment, that may lead to cash outflow or cash inflow. That is an example of investing activity, right? So all these are the different ways in which the company's investing activities take place. Moving further towards the financing activity. In a very simple way, financing relates to how does the company raise the funds for the purpose of its expansion or the purpose of purchasing some big asset, a long-term asset. So financing is related to borrowing, for example, anything which may change the size of the composition of the capital structure of the company, that is basically a financing activity, right? So it could be in the form of equity financing, or it could be in the form of debt financing. For example, when the company issues shares for the public to subscribe, so it is in a way generating cash inflows, and it's financing its business for the purpose of expansion or other activity which the company wants to have in now or in upcoming period. Issue of debentures or bonds, right? Then that will lead to cash inflow. So similarly, if the company has to make some kind of cash payment to shareholders, if it wants to redeem the company shares, right? So that would lead to cash outflow, and it would also be related to financing activities. Classification of some of the cash flow items like interest received. It is categorized as investing activity. Why it is categorized as an investing activity is because interest is received when the company has invested into the bonds or in the financial markets, right? So it might receive some interest on that. If it has invested in the debt instruments. Dividends received is also classified as an investing activity according to the IFRS. And the reason is, again, it is related to the issue of shares. So if the company, it is related to making investment into the equity of other companies. So if the company invests in the equity of other companies, it is likely to receive some dividends from time to time. So if investment in equity is an investing activity, so the dividends received will also be considered as an investing activity. Now, interest paid and dividends paid are categorized as financing activity. And the reason is that the company pays interest when it has either issued shares or debentures. So if issue of shares or the issue of bonds or debentures is a financing activity, so this interest paid or the dividends allied is related to that, right? So it is also considered as financing activity. So this is what the International Financial Reporting Standards or the IFRS permits as far as classification of some of these things are concerned. However, IFRS also permits that whether it is interest received, dividends received, interest paid, or dividends paid, these can also be related to operating activities. So either you classify them, all of them, as operating activities, or as I mentioned before, some of them in investing or financing, but not both at the same time, right? And the reason why IFRS permits them to classify all of them in operating is because all these financial items play a role in the determination of the profits of the company. Therefore, they may be categorized as operating activities, right, guys? So either you classify these as operating activities, or the first two as investing and the last two as the financing activity. If you take my opinion, I would prefer to do the former, which is interest received as well as dividends received is an investing activities, whereas interest paid and dividends paid are financing activities, because of the reasons that I mentioned to you some time back. All right, guys. So moving further, this is a format of the statement of cash flows. Cash flows from operating activities will be recorded first. Remember, this is a simple format. So you are going to list all the cash inflows and outflows from operations, which I explained to you some time back. Cash inflows like when you sell the goods for cash, that would be a cash inflow. Or when you purchase some raw materials for cash, let's say for 10,000 Indian rupees, that would lead to cash outflow because you are making payment to a supplier. So like that, different kinds of inflows and outflows for operations are recorded. Then cash flows from investing activities, which I already told you what are the different investing activities. So they are also recorded. And then you know what is your net cash from investing activities. Net cash would mean either a positive number or a negative number. If the inflows are more than the outflows, the number will be positive, otherwise vice versa. Then similarly for financing activities, you will list down all the inflows and outflows, and you are going to then compute the net cash from financing activities. Then you need to add all of these three together: cash flows from operating activities, cash flows from investing activities, and cash flows from financing activities. So together, when you add, if it's a positive number, that would mean a cash inflow. Otherwise, it will mean a cash outflow. Then you need to add beginning cash balance. Beginning cash balance from the beginning of the year. And when you have added this, what you get is the ending cash balance. All right. So this is how you compute. This is how you prepare a simple format of statement of cash flows. Here, if you look below, it's written the beginning cash balance. You need to add that, right? Beginning cash balance is basically the ending cash balance of the previous accounting period. Now, before I move further, let us do an exercise, guys, right? Because just learning the things, it's like a one-way traffic, right? So we, in a student methodology kind of teaching method, we should have a two-way interaction, right? The students also interact after some time with the teacher and with their fellow students. So I'm giving you an exercise, and all of you please try to let me know, what do you think, which kind of activity is it, before I proceed. Please give me 1 minute. Let me open that slide. It's actually a Word document file, which I am going to share with all of you. So you can see here, for each of these following items mentioned below, you have to classify them as operating activity, investing activity, or financing activity. But if you feel like there is a non-cash activity, you can refer to it as a non-cash financing and investing activity also. All right, guys. So can you tell whether received cash dividends from investments is which kind of activity? You're right. Receiving cash dividends from investments is an investing activity. When you make an investment, that is an investing activity. So once you receive the cash dividend from investments, that is allied to investments, that is related to investments. So that shall also be considered as an investing activity. Cool, guys. The next one, collected accounts receivable from customers. What kind of activity do you think it is? Fantastic. Many of you are correct who are discussing in the class with me right now. This is an operating activity because you are collecting cash from the accounts receivable. Okay, so you are absolutely right. It is related to the revenue generation. It is related to the selling of the goods. Issued bonds payable for cash. Yes, you are correct again. Some of you are correct, although some of you did not speak correctly. But well tried, guys. Good. When you issue bonds, which are payable for cash, you are basically financing your business. So it is a financing activity. You're issuing bonds. Bonds are quite similar to debentures. So once you issue the bonds, you are mobilizing the funds from the public. Paid wages to employees. It's obvious, and I need not explain you. It's an operating activity. The workers, they work hard to generate the revenues, and they are paid wages for that. So it's an operating activity. Issued shares for cash, just like issued bonds, payable. Similar is the issue shares. You want to mobilize funds from the public or from the institutions. So that is also a financing activity. You are financing your business. You are mobilizing the funds for different purposes which you might have. Sold equipment for cash. What is that? Absolutely. One of our students said it correctly. Fabulous. It is an investing activity. You might get a little bit confused, but let me tell it very simply. Once you purchase a long-term asset like equipment, that is an investment into the future, a long-term investment. So when you sell an equipment, that is allied, that is related to the purchasing. So that will also be considered as an investing activity. Purchase land in exchange for a note payable. What would that be, guys? No. This is under the category of a non-cash activity. No cash is exchanged here. In a statement of cash flows, guys, remember that only when there is a cash inflow or outflow, that is what we are going to show. But in this case, there is no actually exchange of cash. One asset is being exchanged for another liability, for a note payable. So there is no cash transaction as such. This will not be recorded in a statement of cash flow. Okay, so this was a twist in the tale. Next, we come to is paid cash dividends. When do you pay the cash dividends? Correct. When you issue the shares. So if issue of shares, you consider it as a financing activity, so will the paying the cash dividend on it as well. So this is a financing activity. Purchase of land for cash, the last one. This is an investing activity for obvious reasons. Okay, so let me get back to the PowerPoint slides for further study. Please give me a moment. Thank you. All right, guys. So we are back to the slides. And when you have to prepare the statement of cash flows, there are two methods how you can prepare it. One is the direct method and another is the indirect method. The direct method of preparing the statement of cash flows sounds simple, yet it can be, in reality, it can be cumbersome. I will tell you the reason. In the direct method, you just recalled all the operating activities or the financing or the investing activities by using the cash account. In cash account, you will find most of the transactions related to cash. But the problem is that there could be so many different there would be so many cash inflows and outflows in the cash account, right? So it will be a tedious task to record one by one, although the softwares nowadays help. Okay, there are accounting softwares, we help in that. But the other one more problem is there. If you use the direct method, which is basically to record from the cash account, I mean, you take the cash account into consideration and then you start to prepare the statement of cash flow. And that problem is that a few times you may find that you don't know whether it's an operating activity or a financing activity or an investing activity. Because in cash account, everything is just written to the point. So sometimes it becomes difficult to categorize or classify the activities based on the transactions that are reported, that are recorded in the cash account. So the most popular method is the indirect method of preparing this. So the accountants globally, right? Globally, not just in India, at abroad also, in Europe also, in the United States also, you'll find that most of the accountants, they use the indirect method of preparing the statement of cash flow. Is the most popular method across the globe. However, according to the IFRS, the International Financial Reporting Standards, they don't mandate which method should be used. So maybe if it's an SME, a very small company, it may still use a direct method. But in case of complex organizations, which are multinational, transnational, it's better that they use the indirect method of preparing it. That might save them some time and might also help them in classifying the activities correctly. So for this purpose, we will use three kinds of information and the financial statements. The comparative statements of financial position, I mean the balance sheet, and comparative means the current year balance sheet is required, as well as the previous year balance sheet is also required for this purpose. But for income statement, you only require the current year's income statement. And some additional information which pertains to the cash as well as non-cash activities may also be required for this purpose, so that you are able to record the correct activities in it. Now, this indirect method, why do you call it as indirect? Guys, do you remember the accounting equation which you studied in the basic financial accounting course? So in that basic financial accounting course, accounting 1, where you studied, accounting equation is assets are equal to liabilities plus equity, right? So assets can be cash and other assets, non-cash assets. So you can put it like this: cash plus non-cash assets is equal to liabilities plus equity. Now, if you bring the non-cash assets from the left-hand side of the equation to the right-hand side, the equation becomes cash is equal to liabilities plus equity minus non-cash assets. So if we are able to analyze this right-hand side of the equation, right? So the right-hand side of the equation shall be equal to, this right-hand side shall be equal to the left-hand side. So if you know the right-hand side, you can easily know what is the change in the cash in the company. The changes in liabilities, equity, and the non-cash assets on the right-hand side will be equivalent to the changes in the cash during this accounting year. So this is a good way of analyzing the non-cash accounts and then arrive it to be equivalent to the cash account. And that's the primary premise or the technical aspect of the indirect method that we will use to compute the cash flows. Now, before we move ahead, this is another important point. First of all, just have a look at it, guys, right? Because this will form basis for you to compute the cash flows from operating activities. So please have a look, and then I will explain you also why is it so. So here it is written that adjustments for the changes in the non-cash current assets and current liabilities, how do we adjust it? So if there is an increase in a current asset, a non-cash current asset, cash we don't touch because that is what we will find in the statement of cash flows. So if there is an increase in the current assets, it is subtracted from the profit. And the vice versa, if it decreases. If it decreases, we add to the profit. Similarly, if there is a current liability, if it is increasing, a current liability, for example, payable, accounts payable, right? If it is increasing, we add to the profit. If the accounts payable or any other current liability, it could be bills payable, it can be notes payable, short-term loans taken, right? But it should be a current liability, not a long-term liability, right? Because a current liability affects the operations. Any decrease in current liabilities will be subtracted. So you need to understand it, and probably you need to learn it, because when you will get a full-fledged question on a statement of cash flows, guys, which we are going to discuss in the next week with you, then you will find the knowledge of this helps. Right. Now, you might be thinking that why a current asset like accounts receivable, right, has to be subtracted from the profit if it increases. The reason for this is, let's take the case of accounts receivable only. If the accounts receivable are increasing, there will be two effects. There will be two accounts affected. On one hand, receivables increase, and on the other hand, the sales are also increasing, right? But there is no cash inflow, at least as of now, right? So when accounts receivable increase, it impacts the profit also. The profit also increase because of the sales, right? So if you want to adjust the profit, then you need to subtract it so that you arrive towards the cash flows, because some part of it in the net profit is non-cash, right? Profits will increase because we are following the accrual system of accounting. So in accrual system of accounting, it's not about cash, right? It's about that a transaction has taken place, right? It is based on the matching principle concept, if you remember what I taught to you a few weeks back, right? It is related, your accrual system is related to the matching principle. So wherein, you record the expenses when they are incurred, and you also record the revenues when they are earned. So once you sell the goods, you earn the revenues or the sales. So sales increase irrespective of that, irrespective of the fact you didn't receive the cash. Now that impacts the profit. Your profit also inflates, right? So if you want to adjust your profit, right, that's an indirect way, and reach towards cash flows from operating activities, then you need to subtract any increase in the accounts receivable. And the opposite will hold true when your current assets, they decrease, right? In the similar way, the current liabilities also, if they increase, they are added to the profit, and if they decrease, they are subtracted from the profit. Right, guys? Why is it so? It is so because, let's take the example of salaries payable. Okay, salaries payable is an example of a current liability. Salaries payable, salaries accrued. So if they decrease during the year, this decrease, as I told you just now, it's subtracted from the profit. It means that the company paid off more in salaries than it charged to the expense during the period. So this excess of cash payments over the charges, over the expenses, is used to adjust the accrual based expense reported on the income statement to report the total cash paid for salaries during the period. So this is from the reasoning point of view. If you understood, it's good, right? If not, you can ask me again. Let me finish my lecture and you can ask me more questions related to this topic. So when we have to compute the cash flows, The first thing, and probably a little more complicated, is to compute the cash flows from operating activities, because herein we have to use this indirect method more. So how do you compute the cash flows from operating activities? You always start with profit before tax. This is specified by the IFRS. The IFRS rules say that you need to start with profit before tax. But if net profit is given to you, net profit means net profit after tax is given to you, then you need to add income tax expense to arrive at profit before tax. Right. Why profit before tax is the starting point according to the International Financial Reporting Standards is that IFRS wants that income tax paid should be shown separately within the cash flows from operating activities. So once you have this, then you need to adjust the profit before tax, reconcile it to the net cash from operating activities. So you will have to add some financial items and you will have to deduct some financial items. So depreciation expenses added back. The reason is it's a non-cash expense. So it was unnecessarily, you can say, decreasing the profit, right? And it's a non-cash item. So you need to add back now. Any non-cash expense like depreciation or any kind of amortization relates to intangibles, that needs to be added back. Loss of sale of property, plant and equipment, this pertains to the investment activity. And then again, so it is not part of the operating activities. So this loss of sale of property, plant and equipment, it would have decreased your net profit. So you need to add back now because you want to move from profit towards the cash flows from operating activities. Then, as I told you before about the increase in current assets like inventory or receivables, that will be deducted. Any decrease, vice versa. Any decrease in current liabilities would be deducted. Any increase in current liabilities like interest payable, salary payable, that would be added back for the reasons which I mentioned in the last slide. See guys, it will come with practice, right? The more we will practice, the better we shall get in a statement of cash flows. And believe me, as future accountants or finance managers or CFOs, right, knowledge of statement of cash flows and how is it prepared is critical or crucial to the successful running of your business and getting a good insight about it. Then finally, just sum up this, you get cash generated from operating activities, deduct the income tax paid, and what you get is the net cash from operating activities. So this is how we compute the cash flows from operating activities. So before I move forward, the time for today's session is getting over. I wanted to tell you more. In the next lecture, I will discuss about how to compute cash flows from investing activities and financing activities, and then how to add everything to get the net cash from, how to get the total net cash from all the activities of the organization. That I'm going to discuss in the next lecture, and I will give you some examples. In fact, I will ask you to do 1 or 2 exercises also on that day, so that the experiential learning or the problem-based learning takes place. Thank you very much, guys. Have a nice day.